The firm's banking and finance group. I want to thank you again for joining our automotive update panel today. We have a great panel with great panelists. But before we get started, we'd like to thank our sponsors. They should be on your screen. Without our sponsors, we cannot bring this programming activity to you. In addition, as things start opening up, we're going to be getting back to in-person events for which our sponsors are even more important. So thank you again for that. If you have questions and answers, please use the question and answer box on the screen. Please don't use the chat box. We're just going to be monitoring the question and answer box. And then immediately following the session, there will be a networking event. So to get started, we're going to go through and cover several topics today. Current industry trends, capital market updates. We will focus on the chip shortage, some of the electronic vehicle issues, the SPACs. We're going to take a focus on M&A, both from the private equity space as well as lending space. So with that, I will turn it over to Steve Wybo to do his introduction. Steve?
Thanks, Ted. Good afternoon, everybody. First, want to apologize for my attire. I had to drive to Chicago this morning at 5 a.m. and Ted said we had to wear suit coats, and I realized I left mine in my closet, so I didn't turn around and go get it. So I'm not keeping up with my three colleagues here. But anyway, 20 years at actually 21 years at Conway MacKenzie now. Run our auto practice and also run our Detroit market. Sit on the board of our firm, which is now called Riveron. And I've done many of these panels and know many of you, and I'm grateful to the TMA for being able to participate here today. Sanjeev?
Thanks, Steve. Hi, this is Sanjeev Varma. I'm Senior Advisor to the investment bank Lincoln International. I'm the advisor for the global automotive industry. I have been in the industry for 36 years. I spent 20 years working at Chrysler, New Venture Gear, and Magna Group companies from product to manufacturing to sales, marketing, and strategy. Last 16 years, I have been in investment banking at different banks, doing restructuring, M&A, and capital raising. Vlad?
Thanks, Sanjeev. Vlad Slapak, Comerica Bank. I run our middle market and business banking workout groups here in Michigan. Also, been on these a couple of times, worked with many of you throughout the industry multiple times. And again, thanks for having me on again today. Ted?
Okay. Like I said, we're going to cover several topics here today in current industry trends. We'll get started with that, and I'll turn it over to Steve.
Okay, thanks, Ted. My section, guys, I just want to kind of frame up the industry and what's going on today as compared to, I think, 6 months ago when we talked to you, and then 6 months prior, right around the time COVID hit. And I've got 8 or 10 slides, which Vlad and Sanjeev will chime in, and then I'll hand it over to Vlad to talk about capital markets. But a lot of the stuff is well known to us, especially those of us that live in Detroit. But you really can't talk about automotive until you talk about volumes. And I won't cover every word on a lot of these busy slides, but I think the TMA will make this available for people to read later on. But basically, if you focus on 2020, and these are global units, we did about 75 million as compared to 89 the year before. And a 16% decline in a COVID pandemic is frankly remarkable. And the fact that this year is going to be 83 or so and rebounding to near 90 next year, which would be higher than pre-pandemic levels, is really again a remarkable recovery. So none of us in the industry would have predicted this a year ago. I know when we had the webinar, then we had no idea what was going to happen. We were all planning for massive distress. Workout departments were staffing up. Government assistance was being sought by the likes of the OESA. I was working with the government and the OESA to try to secure that financing, and it was chaos. And it's really hard to believe how quickly the industry rebounded. And frankly, if we didn't have this microchip issue, 2021 would even look a lot stronger. And we'll talk about that here in a little bit. But really a phenomenal story. We are in a very, very robust industry with a lot of challenges, which we'll cover today. North America, kind of the same story as global, so I won't spend a lot of time on this here. What I will say, though, is earlier in the year, it actually would have looked better. And we're seeing a lot of volumes being pushed right that we thought were going to happen in 2021 and likely now will happen in 2022, as you can see here on this chart. And again, that's mainly a result of what's happened with the microchips. So we're hearing about this, and I think, again, if you live in Detroit, everyone knows we have these issues, but what is it? Why are we having these issues, and why haven't they been resolved by now? And I think in Detroit, we all tend to believe that, we're a massive industry that has a lot of pull and is very important to many of the input costs. Certainly, the OEMs are very important to tier ones and tier twos that we deal with every day, but they're not that important in terms of size and scale and actual purchase components for certain commodities. Plastic being one of them, for example. The other one happens to be microchips. And so, long story short here on this industry, the auto industry is only about 10% of the total microprocessors, microchips. The chips are the issue, the wafers are the issues globally. So it's not that big of a customer for these limited producers. And when we shut down about a year ago for 13 weeks in the industry, you may remember, we shut down buying everything, including microchips. And microchips are needed for lots of things that we bought during the pandemic: computers, televisions, iPads, iPhones. So we had everyone working from home, buying new technology. There's a huge demand shift from the 10% or so that was going into the cars over to all these other consumer electronics. And we basically lost our place in line in the auto industry. And 13 weeks later, we called them back up and said, okay, we're back in business again. And the demand is a lot more than we thought. So we need that same allocation. And these limited producers said, well, we reallocate. And we don't have that full amount of capacity available anymore. And by the way, it takes about 24 weeks to shift it back. And it takes $300 million to build one line, which we're not going to just aggressively do. So get in line, basically, is what happened. And you can see here, of the 15 or so producers, who the big players are. One in particular, TSMC, didn't even take orders until around this time to get the autos back in line. So I've oversimplified it, of course, and there's a lot more to it than that. But basically, we had a huge demand coming from other industries. We lost our place in line. When we came back, the allocation had shifted, and it takes some time to move that pendulum back, which is happening right now. So with this chart, we think in North America alone, which is about a 16 or 17 million unit industry or market, I should say, we lost about 1.3 million units specifically related to the microchip shortage. So we'll make up 500,000 or so of those units in the second half of the year, and hopefully the rest, assuming the demand continues to be strong in 2022, which we believe it will. But that's a fairly significant amount of units that, frankly, the industry just can't produce to completion without the microchips. So, if you're a lender or a private equity owner or a consultant or an accountant advising these clients, you're seeing this real time as I am.
Hey, Steve, a question we have.
Yes,
when do you think this chip shortage will be resolved and the OEMs will get back to normal production and normal production schedules?
I think it's later in the year at best, Ted, and probably more like first quarter where we can get back to more predictability in our scheduling. The OEMs would tell you it's earlier. The releases that we're seeing starting in the third quarter, which is just a couple of weeks away, are very robust, more normalized run rates at 16 plus million SARs. But we're still seeing pockets of choppiness, and we're still seeing certain platforms being reallocated to the high runners and the high margin vehicles. So, again, it takes about 24 weeks to get the capacity back online, and I think it's about half a year, and I think we're just starting to see it now, and so it's going to take the back half of the year to get it normalized and corrected, I think.
Well, that's interesting because in my practice, our borrowers are telling us that third quarter, early fourth quarter. So it sounds like you have a little more pessimistic view of that.
Yeah, I think it's more like fourth quarter, first quarter. I hope I'm wrong, but that's not to say we're going to have a massive shortage, but to in automotive, you need reliability and consistency. And what we're seeing with a lot of our clients, which creates a lot of waste, a lot of instability, is start, stop, start, stop, start, stop. So it's tough to schedule a plant with your people, and your labor costs go up when you're doing that. Your material costs go up. Your transportation costs go up, et cetera. And until we get back to a more predictable, sort of normalized cadence, I don't think the industry is going to be running efficiently, and I don't see that until fourth quarter, first quarter.
Thanks.
Okay, so what this chip shortage has done is it's created a massive amount of shortages at the dealerships. I was just at a dealership yesterday. If you drive by a lot of the dealerships, a lot of them shop, you'll see the front of the dealerships. They're strategically placing units to make it look like they have more inventory, but then when you drive around back, the lots are empty. And that's what the numbers show. We have a record low number of days inventory on hand. I think it's about 35 days right now. A healthy amount is 70, 80. I think Toyota announced they were at like in the teens last week. So we're seeing a massive shortage of units. Sometimes you can't even order a unit right now. And I know GM, for example, has certain units on hold, and certain units you can order without certain options. I know somebody tried to order either a Tahoe or an Escalade, and with the running boards, some of them retract into the vehicle, which obviously requires a system or a chip, and you can't even order that option right now. That variant is not even made available to the consumer. You can buy the one that's fixed, that doesn't retract, and that's only because they're trying to use those chips for other areas of the vehicle. So it's certainly impacting the way consumers buy vehicles, and certainly impacting the inventory of vehicles available on the lots today. Okay, so future production outlook. Again, I think we talked about this earlier. This is just a little breakout by region. If we get to 90 million units next year, which I think we will, I think that actually we could actually get a little higher than that with the shifting right of what we're seeing in 2021. We will have exceeded 2019, which is a very robust year. And a year or two later, we're starting to approach, once again, record volumes. So pretty amazing recovery. Hard to believe that we only had a 16% softening last year, and that we've snapped back with the overused V-curve term that we're seeing here. I'll pass this to Sanjeev in 1 second, but I will say that we did these panels a couple of years ago, and we were talking about electrification, and we were seeing all the money thrown at Rivian, and of course, GM had a product out there, and Ford was kind of late to the game, and obviously Tesla was sort of this new entrant that sold 30 or 40,000 cars, but it was hard to believe their stock valuation. And we were all saying, yeah, it's coming, but man, it's a couple decades away. That has changed significantly. And just a couple years later, we were all wrong. All of us that predicted that it was decades away. It's not decades away. It's here now. It's coming fast. Ford has a very attractive pickup truck that has 100,000 units on order, which will be out very soon. We're obviously seeing the Mach-E on the road by Ford as well. General Motors has a very attractive product. Tesla has really taken off in terms of its sales, and many other manufacturers have plans to be more than 50% electric a hell of a lot sooner than any of us thought. So it is absolutely here. It is certainly here in China and Europe more so than the US, but we were wrong on the timeline. It has been accelerated. And I think mostly because Wall Street has rewarded these companies, and Ford stock has traded $10 a share for a decade, and just recently with its EV shift and its strategy and its product that's come out, it's up 50% just in the last couple of quarters, I think. So Wall Street's rewarding electrification. There's lots of money still chasing it, and it is here. And Sanjeev, maybe a comment or two from you on this.
Yeah, talking about money, I just read a report that suggested that $2.7 trillion will be needed to transform the entire global auto fleet from IC engines to electrification. And so far in the world, we have only invested $200 billion. And so there's a long way to go. So the transformation of the automotive industry still has a long way to go, and a lot more things will be seen by us in this industry. And just today, in case you saw that, GM just announced that they're going to add an additional $30 billion of investment in electrification. So with the investment that has been made, the industry transformation is inevitable and unstoppable. Electrification and electric vehicles will disrupt not just suppliers, but dealers, the aftermarket, and the way cars are sold and serviced and used. Vlad, I know you have a few comments on this.
Yeah, I think the other part of it too is banks are talking about this on a daily basis. We're talking with our customers, and we're also talking internally about where the auto industry is shifting and how these suppliers are shifting and what their strategy is going forward. I know maybe 2 TMA auto events ago, we were talking about interior components for radios and heat, because now it's all on a screen. We were talking about last time drivetrain components that are needed and the transition from ICE to EV. And so, this is a daily conversation now. It's not something like Steve said, where we were talking about 5-10 years of slow transition. This has been accelerated.
Thanks, guys.
Hey, Steve, let me throw out a question for you. The statistics would show that the consumers in China and Europe are much more accepting of the electric vehicles as compared to the United States and the rest of North America. What do you think it'll take for the US and the rest of North America to catch up in terms of the consumer demand for electric vehicles?
I think it's more policy driven, Ted. I think, government regulations on whether it's CAFE type standards or incentives, bringing the price of the vehicle down by having more incentives, certainly availability by the domestic manufacturers in terms of product, which we're starting to see, every day there's a new electric vehicle announced. And I mentioned a couple of the nameplates that are currently launched. But we've seen penetration 3 or 4 or 5 times in China and Europe than we're seeing in the US, like 10% compared to say 2%. So we have ways to go to catch up. But also I think infrastructure is going to be critical. And Americans drive a lot of miles, and if you're going to drive from Detroit to Grand Rapids and you have to stop for a charge to come home, that's just not convenient. And you're not going to wait, a couple hours or 45 minutes to get enough charge to come home. So you're going to have infrastructure, acceleration of miles per gallon, so you don't get or miles per charge, I should say, so you don't get the range anxiety, but also the ability to charge and do quick charging at various places, which currently we just don't have. Okay. So I'm going to wrap it up here in a second and toss it to Vlad. But just, we talked about chip shortages a lot, and that's certainly what we're seeing in the press, and it's front of mind. But we've had sort of the perfect storm with almost everything. Almost every input cost has been challenged in the last 12 months since we relaunched the industry. And one of the things that's I think overlooked is the staffing issue. That there is an absolute staffing shortage. Every one of my clients comes in every day and wonders how many people they're going to have on the floor, and they've had to reallocate on a daily basis. Again, that leads to inefficiencies and output and throughput in manufacturing, and that yields higher costs. You're working weekends to catch up, and so the availability of people, and when you do get them, you got to pay them. You have to pay more for them. So the input cost of labor, which depending on the commodity could be 10 or 15% of your selling price, has gone up. We're seeing the price of resin has gone up. The price of steel, if you follow the crew on a gross ton basis, has gone up 40, 50, 60%, depending on the grade. Transportation has gone up significantly. If you have to expedite something from a port, I've heard some suppliers recently saying they've had to pay 500, 600, 700% of what they were paying pre-pandemic to get something out of a port. Insurance has gone up. D&O insurance is through the roof. And so if you look at sort of the P&L and go down from the most expensive cost, which is usually raw material, all the way down to the least expensive cost, healthcare has gone up. All of these input costs have gone up. That's going to inevitably squeeze margin. The inefficiencies that we're seeing from all the shortages that we're seeing is going to decrease efficiency, which again squeezes margin. And it's not like the OEMs are sitting there saying, bring the price increase to me and I'll gladly pay it. So we absolutely believe there's going to be, despite these great revenue numbers we're predicting, there's margin compression that's happening. And ultimately, the banks, and Vlad will talk about this in a minute, they're going to have to address some of these troubled debt restructuring, some of these covenant defaults, and the Fed's willingness to continue to look the other way on some of these things is really coming to an end. So, we're not saying it's going to be a bloodbath like we were predicting, a year and a half ago when COVID, first hit. But we do believe there will be more challenges, and we're starting to see some cracks currently. But there will be more challenges for our auto supplier clients. Okay, and then lastly, maybe Sanjeev, you can cover this one as well, but this will tee up in a few minutes your presentation after Vlad's. But the M&A market is pretty hot. There's certainly a lot of money on the sideline. But Sanjeev, why don't you comment and tee up your section for a little bit here?
Right. So the M&A market has been very robust, and actually, in Q2 it dropped last year, but it has been Q3 and Q4 it came back up. In Q1, it went down again a little bit because we thought that we might be going into COVID too. But the big news here is that there is ample capital available for doing M&A transactions. Debt is still low. And so we will see M&A, a robust M&A happening. And I'll talk about that in my slides.
Okay. Vlad, over to you on the capital markets.
All right. I think we can touch just briefly on the bond market. Average size here is 800 million. So I think most of us aren't necessarily playing in that market on a daily basis, but it does remain strong overall. Right, this has less sensitivity to interest rate risk, and more importantly, there's a lot of capital to deploy, and leveraged balance sheets are more common, and it's there to help navigate through this economic period. Part of that leveraged balance sheet, I think we're slowly getting used to leverage coming up. With the recent changeover in our government status, there's a higher propensity for greater fiscal spending. 1.9 trillion of the new administration for the COVID relief, and I think Biden, I was reading, had another 2.3 trillion for infrastructure and economic stimulus. So we're talking over 4 trillion in economic stimulus from the government, which the Fed says about 6.5% growth with only 2.4% inflation. So it seems as if we're in a little bit of a period here where we're trying to understand where the market is going. But at least right now, the bond market is still strong. If we can go to the next slide, Steve. Which then taps a little bit more into where we're playing, broadly syndicated, and trending down. And really the key here is private capital markets are continuing to grow, and they're continuing to generate more activity based on covenant light type structures, pricing being somewhat competitive with bank. And more importantly, a little bit more flexibility. But just in general, I think we can all kind of see that the volume was down primarily for the pandemic, but even in 2021, it's continued to see similar trends. And when we think about banks over the last 20 years, the consolidation has been intensive. I mean, there are 50% less banks in the last 20 years. Top 25 banks hold about 50% of the C&I debt, and again, from a 250 million in broadly syndicated, it's down 10%. So this is really a changeover, I think, from many perspectives, not just other options, a lot of capital on the street to allocate, but it also has to do with a little regulatory. And Steve, if you can jump over the 17, I'll come back to 16, or I'm sorry, 18. But it really goes into the private capital market. And so what you have here is you have covenant light, you have less structure, typically weaker documentation, and higher leverage. There's a greater willingness for risk, and investors want a return. And so you start seeing this market growing, and really the private credit market is growing at the same pace as banks. But when you think about 20 years ago, it was such a small piece of the market. And so, it's beginning to fill a void, and that void is a little bit twofold. The void comes from, regulatory constraints that banks have, but it also is a return item as well. And so, I think there's definitely a change in the way capital markets are being addressed and where things are headed. When it comes to banking, higher regulations, but when you think about things like the CARES Act, PPP, and other government programs, the Fed still uses banks as the vehicle to dispense certain government programs, and so even SBA as well. So there's still a high importance for banks. It provides a very key part of the capital market option, but it's definitely changing over the years. And then especially all of us who've been in for 20 or more years, I think we can all say that the banking industry has changed significantly. The continuation of the CARES Act and banks' abilities, our ability to quantify and categorize loans differently based on where we are in today's market, and treating TDRs differently because of restructure requests. Specifically COVID, of course, has seen a great deal of change in the marketplace and the ability to be a little more creative and deal with defaults without categorizing as troubled debt. But as COVID starts going away, now we start having extraordinary situations. As Steve had mentioned, we have the chip shortage. And, I think we're all very aware that we're going to be talking about a labor shortage along with the ramp up. And then it'll fall right into a liquidity shortage potentially, as there's some high growth needs for working capital as they turn on the volumes again. So I think there's a lot going on in this industry, but right now it still remains strong. And one of the new pieces of it really is that the private capital market growing and continuing to really structure competitively with banks and continuing to gain a little more momentum, but generating a little higher yields. And then we'll move into Sanjeev.
Quick, before we do that, quick question, Vlad. You mentioned the liquidity, particularly as the economy heats up, inflation is rising. There's a lot of demand, particularly in the automotive industry. Do you see that there's going to be working capital constraints on companies, particularly the automotive industry, or will the combination of banks and private lenders and private equity fill that void, or do you think there'll be a working capital crunch?
Ted, yeah, I think there will be, as we look towards third, fourth quarter, and even the first quarter of 22, it appears if there will be some liquidity needs. As we see these fluctuations, in order, as Steve had mentioned, when you turn off and then turn on, turn off and turn on again, it doesn't always retain the liquidity within the business because you have overhead needs. And so it's going to be difficult, I think, for banks and borrowers, and especially in the auto industry, because it's so reliant upon inventory, and that inventory typically is 30, 40, 50% of the product part. I see that there's going to be needs for liquidity beyond your typical formula base. And so is that going to come from the banks? Is that going to be coming from ownership or the sponsor? Mez, Ted, I think it's a little bit of every piece and component of that. But as government funding runs out, and as margins are compressed, and as the need to get product out the door and hiring, again, I think we're all reading about how even all jobs, whether it's transportation, manufacturing, are requiring bonuses just to get people in the door. And so as those costs of capital go up, I think there's definitely going to be some bottlenecks on working capital, which will as well, cause some concerns to the supply industry, specifically in the auto world.
Thanks, Vlad.
Steve? Okay, so let's look at the M&A environment in the auto industry, how it has changed since last year. So if you look at the chart, you will see that we were doing M&A. M&A was quite robust in the automotive industry. You can see the size, the total value of the deals and the number of deals, but you can see a sharp drop in the Q2 of last year, where pretty much everything stopped. I mean, buyers and sellers stopped, and the banks stopped talking about lending. So everything came to a standstill. But in Q3, it came back, but Q4 was pretty good actually, because those deals that wanted to get completed, people came back and started and wanted to complete the deals, even though not all the deals were completed as planned, but you can still see that we had a bounce in Q4. Now in Q1 of this year, we had a decline in the number of deals and also the value of the deals, because we still went into lockdowns and we had issues. We thought COVID-2 might be coming back. And so we had a slowdown this year, slowdown in the first quarter of this year. But what is interesting about this chart is that if you look at the folks who are buying companies and investing and doing transactions, majority of them have been strategics. So the total number of deals and the value of these deals, strategics have been playing a larger role. But this does not mean that private equity is not out there. Private equity is sitting on significant amounts of capital, and they are also looking at deals. But they look at deals when they are at good value, and the valuation have changed over the years. So they have been more strategic, so to say, in where they invest. But the private equity funds still are sitting on tons of capital. And this year, as you can, and also the other point to remember here is that, as the auto industry transforms from IC engine based to electrification, consolidation is going to happen. So we expect high M&A volume to continue this year. This is an interesting chart. What we did is that we looked at not just the industrial and the automotive segment, but we looked at 6 different segments: business services, consumer, energy, healthcare, industrials, and technology. And the reason we did that is we wanted to see how the auto industry, where we are fitting here and where the other industries are and what are they looking at. So what we find here is that irrespective of COVID, this shows that the M&A trend in the middle market has been pretty strong across various industries. And we know the reason for that. And the reason is that PPP and the government loans supported many of these companies in these segments. And so that was very helpful. Also, the other thing is that leverage is still high and the valuations are also higher. If you look at the bottom left of the slide, that is a very interesting thing to see here. The valuations have gone up, but valuations have not of S&P 500 companies have gone up, but valuations of lower middle market companies have not gone up as much. And that the reason is very clear. They were more vulnerable to the changes that happened during the COVID period. They had little more difficulty in raising money and getting labor, and there were many issues. So you can see that the valuations of the lower middle market companies was not as high as the S&P 500 bounce back. The other thing we see here is that if you look at the 6 different industry segments and where they are today after COVID and where the enterprise value is, you can see that energy was hit the worst. They were the low, they still have not come back, and we know the reason for that. Oil-based, we are still an oil-based economy. And you can see that some of the other industries that have come back with a big bang, technology and healthcare and business services are doing well. Industrials and automotive is somewhere in the middle, but we are in the positive range. So the automotive industry valuations are back, and especially for middle market companies. Steve. Okay, this is another interesting way to look at what happened and what did not happen this time around. As you know, in the 2007, 8, 9 timeframe, we had significant amount of distress. The government bailed out 2 OEMs, and we had several suppliers that filed bankruptcy, and there was a lot of consolidation and liquidation. But this time was different. We did not have as much as we had last time, and the reason was, again, the PPP loans and the government support. But what is interesting here in this chart is that we looked at 26 companies in the automotive segment, and we said, okay, how were they positioned last time versus this time? And these 26 companies were picked from the top 100 auto parts suppliers. They had to be all public, and at least 50% of their product was automotive auto parts. So what we found is that the suppliers last time around where the median supplier, the current median current ratio of these 26 supplier group was 1.75, and the debt to capital was 0.3x. But this time around, if you can see the chart, you can see that many of the suppliers were below that median that we had the last time. But despite that, we did not see enough distress. And the reason was very simple. Cyclicality in the auto industry tells you that there will be distress and turnaround, but that did not happen because the government intervention broke the cyclicality. But once the government intervention goes away, as Steve and Vlad were saying, the cyclicality of the auto industry will come back. And some of the issues that we faced last time may come back about liquidation, as Vlad was saying. Not liquidation, I mean availability of capital and working capital issues. So we have to be watchful of where we are going in the middle market companies and other companies in the auto segment. Steve. Okay, wanted to touch briefly on SPACs because we are talking about where we are going in terms of capital raising. There is ample capital available to companies, but some companies have taken the SPAC route to go public. And the reason we wanted to talk about that is because this is a trend, and this is a trend which is not going away. And I will talk about that as to why this is not going away. So what is a SPAC? A SPAC is a special purpose acquisition company. In plain English, it's a public company which is an empty shell. There is nothing in it, okay? So SPACs have a share price of $10, and there are some warrants that are issued with that. And investors have to put money in a trust for 2 years, during which the SPAC has to find a private company to merge with it, thus taking the private company public. Now, if in 2 years the SPAC cannot find a private company to merge with, then the funds have to be returned to investors. Now, SPACs have been around for a long time. They are much faster and easier to create. In 3 months, you can do it. And they have become more popular recently because of the significant amounts of capital available to deploy. But the problem is that based on the 2020 data, we know, as you can see on the screen, only 2% of the SPAC funds that were raised went to industrial or automotive deals. Now, some of the deals you have seen and heard about, Nikola and Lordstown and some of the supplier companies like QuantumScape, the lithium-ion battery company, and then Luminar, the LiDAR company. I mean, there are 4 LiDAR companies that went public using SPAC method. So there's a lot of money available for high technology companies, but still it's only 2% of the total amount raised in the SPAC business. So here it is easier to do a SPAC today, but there are some issues which I will talk about in the next slide, Steve.
Hey, Sanjeev, before you do that,
yeah.
Obviously we've all read about Lordstown this week and the change in management. Accounting regulators run out of cash. Mm-hmm. I look at this list and I see Fisker. Well, they filed for bankruptcy 5 years ago, so is that just a redo? GM's lost some confidence in Nikola along the way, and every one of these has a story. Yeah. Do you think investors are starting to get a little skittish with these SPACs? And I know it's been very robust. Our firm and our advisory side does a ton of work, but it seems to me that it's coming to an end. But I don't do a lot of work in this space, so curious in your view. No,
it is not coming to an end. I'll tell you why. If you go back, history is our best guide, Steve. If you go back historically to 1999, 2000, 2001, there was a wild internet euphoria. We were actually putting companies public that were selling wine and fruit and vegetables, okay? And we know what happened. We had a collapse. But after 2006, 7, 8, again, we had issues. But now, 15 years later, we know that internet is here to stay. E-commerce is here to stay. The world is doing business communications and transactions using the internet. The internet has become more stable. E-commerce has become more stable. Now, with the SPACs, let's see what happened with SPACs. SPACs have been around for a long time. They have become popular more recently, but this is a hiccup. So what are the 2 reasons why there is a hiccup? The first reason is that SPACs are authorized to actually make projections on their business much more openly and in more detail than IPO companies that are going through a regular IPO. So what happens is that companies that are not due diligence properly and they provide projections which they are not able to meet, for example, with Nikola or with Lordstown, they get into trouble and the SEC comes after them. So that's the one reason why there is a hiccup and there is more skittishness on behalf of the investors. But there's a second reason. And the second reason is that if you look at the capital structure of a SPAC, there are warrants issued with every share that is issued at $10. Now, those warrants were identified by investors as equity. The SEC doesn't like that. SEC looks at a SPAC and says, those warrants are a liability. Well, guess what? Your balance sheet just changed. So when that happens, the return on investment is lower, and people are wondering whether or not the SEC is going to come down on SPACs a little more than what it has done in the past. So those are the two reasons. If you can change the slide, I will continue explaining, Steve. So one of the reasons, so two reasons why this has happened. Now, what does it mean? Does it mean that the velocity of SPACs and the number of SPACs that are being created is going to go down? Probably yes, but look at the screen. There are so many SPACs which are still out there waiting to identify private companies that they can take public. The capital is out there. It is sitting there in treasury stock. And who wants to take 3% or 4%? I mean, they want higher returns. There will be deals, but what's going to happen is that there will be more regulation and oversight of SPAC process, SPAC companies. And in a few years, they will become more stable. Just as today, we know that internet is stable and we are doing e-commerce and transactions. Similarly, the same thing will happen with SPAC. There is a third reason why SPACs will continue. And that reason has to do with the way capital is raised and who can buy shares in a publicly listed company. We all know how our IPOs happen, and we know that investment banks raise money from institutional investors first. So the number of companies that can invest in a SPAC is very limited. Institutional investors. A SPAC, there's a difference. In a SPAC, the retail investors have the ability to invest in SPACs. So it is more democratic in that sense. And therefore, over a longer term period, I think SPACs will stay around. They may become more specialized, they may become more niche, but they will be around. The only issue with SPACs for the auto industry is that if you look at the screen, the trust value that is in treasury stock today for all these SPACs, you will see the lowest number at 300 or 230 actually. I cannot get a return call from any investor or hedge fund for any SPAC deal less than 500 million. I mean, it's impossible. So companies have to have technology or have to have some other angle to have a high valuation, 500 million or higher, maybe $1 billion, before SPAC investors get interested. So those are the issues that we will face. Bottom line is SPACs are here to stay. They will look different. They will be regulated more. They will become more stable, and there'll be another means of raising capital in the capital markets. So that's the bottom line here from my view. I think next is Ted.
Yeah, before I go there, we wanted to touch a little bit on the mobility issues, Sanjeev.
Yeah.
What do as that push continues, although it seems to me just anecdotally, that unlike the electrification, that seems to be getting pushed out further. But as that continues to progress, what do you see as the implications for the suppliers as we move towards the autonomous vehicle and the various levels of autonomy?
Right. So we were all enthusiastic about autonomous vehicles when they first came out, and we still are. That is going to happen. Why is it going to happen? Very simple reason. Technology has to be deployed. If companies and suppliers have sensor technology and they have radar technology and it can be integrated and there'd be cloud-based database, cloud-based systems where data is available, a car can do a phenomenal number of things. And for example, General Motors has actually hard-coded 130 miles of road data into the chip. Tesla doesn't have it. So Tesla is going to be a different situation. Autonomous vehicles are here to stay because Tesla started the trend. There are other companies that have sensor technology and they will integrate. Now, there are two parts to the autonomous vehicle program. One is whether they are IC based or whether they will be electric. Now, if they're IC based, nothing changes with suppliers, but that's not going to be the case. Autonomous vehicles, because they have so much technology in it and they have electronics and they have software horsepower, obviously they will go towards electrification because the systems are similar and comparable. And therefore, I feel that autonomous vehicles will mostly be electric vehicles in the long run. So when that happens, the supply base will change. The supply base that exists today in the IC engine will change in two ways. The first way is pivoting. They will have to pivot and start using their manufacturing and design engineering competence to make components which are going to exist whether a car is electric or autonomous. Things like suspension parts or chassis parts or brakes or other technologies. Other way is that these suppliers will have to consolidate and become either bigger or they will be bought out. But there could be other creative corporate structures which will allow these suppliers to continue to survive. There's a third way that is going to happen is that aftermarket companies, which are very clever at doing lower volume products, making lower volume products and getting a higher margin out of those, they will enter the OEM and the tier one supply base. And they will try to make parts for the IC engine cars, because those cars are going to be around for decades. We have 300 million cars on the road today. They are all IC engine based cars. So that market is not going away. So suppliers simply have to pivot in a clever way. And that's the way I see going forward.
Thank you, Sanjeev. Okay, we'll open up now for some questions, Q&A from the audience. Please use the Q&A box if you have any questions. And while we're seeing if any questions come in, I just want to remind everybody that there will be a networking session immediately following the panel. The link for the networking was in the email that was sent out by Amanda, but in any event, she will repost the link when the presentation ends. We'll also invite anybody to please check out the TMA website, TMA Detroit website for upcoming events. We have several events, including our in-person fall kickoff coming up. So please check out the network the website for that. And we'll see if any questions come in before we conclude. Let's give it a minute or so. Not seeing any questions coming in. Did any of the panelists want to make any final points before we conclude today?
Electrification is here. It is going to transform the industry in ways that we cannot foresee. And I think, as Steve said, it came in faster than we expected. And we should all be prepared for it and accept it. And autonomous vehicles are much farther than we thought. They will come much farther out than we thought. But they are also here, and they will come one day.
Steve or Vlad, any parting comment?
Yeah, I just my question to Sanjeev on the SPACs, not that they would die, but maybe that people will be a little skittish with automotive. My prediction is they will. Yeah. And you saw that list; it was pretty lengthy, and there's going to be a lot of Pontiac Aztecs in that list.
Oh yeah,
in my opinion, and there's more Lordstown news to come with some of those that will just never, failure to launch will be term I think we'll use with some of those SPACs.
But Steve, the other side of the coin is the fact that there are 65 LiDAR companies that venture funds have invested in. 4 of them have gone public using SPACs. There are 3 of them which have technologies which are very good and creative. If you look at the LiDAR space, the technology is evolving to complete solid state and even beyond solid state. There is no true solid state LiDAR company today. There is 1 or 2 companies who are developing that. And once they come into the market, the Velodynes and the others will be in great difficulty. So there is still a lot of room for SPACs to happen with such companies that have technology today that the auto industry wants. So it will evolve in a different way because people will keep inventing. But yes, there will be more skittishness unless LiDAR companies that have gone public today really fail and autonomous gets so much delayed. Otherwise, I think SPACs are here for high technology and good companies here.
Yeah, and I think the last part too, though, is as the consumer gets potentially more comfortable, it is, as Stephen mentioned, it's going to take some government intervention as well, whether that's recharging stations, whether it's sensors in roads. There's still a great deal of infrastructure need in order to make this an everyday vehicle. So it'll be interesting to see how that rolls out and what companies can take advantage of that.
Right.
We've got a couple questions. One question is, and I think maybe for the group is, do we think Detroit is ready for the electrification, as opposed to, Europe and China?
I think the OEMs are absolutely ready. They've made some public statements that they're going in that direction. Mary Barra said, it's going to be all electric by 2035, I think it is. So as Sanjeev said earlier, the commitment's there, the money's there. There's no turning back unless some kind of other alternative fuel comes out that's cheaper and easily distributable. But we're headed in that direction, and the pendulum has definitely swung. As far as us being ready, as I said, the infrastructure is definitely not ready. The car companies have been making electric cars for 30 years. So the technology is not all that new. It's evolved very, very rapidly over the last, half a decade or so. But Detroit can make a great electric car. I think that F-150 Lightning is going to be a phenomenal car. The Mach-E is selling very well. And so, yes, Detroit can make the car. They can make it electric. I just think the infrastructure in Detroit and the rest of the U.S., frankly, needs to catch up.
Here's a very interesting question. I hadn't really thought of this, although I've seen some things about this, and that is, with the electric vehicles, they're obviously very technology heavy. I think someone has said that Tesla is a technology company masquerading as a car company. And then obviously the autonomous vehicles would take that a step yet further. And then particularly in light of the ransom cyber attacks we've seen and ransomware, will the vehicles be subject to those same type of attacks, either by terrorists or hackers or others?
My answer is the possibility of that is high. And we did a detailed study of cyber security companies which are trying to enter and support the automotive industry. It's a long list. OEMs are trying to figure out whether they are the ones who are going to put cybersecurity in the vehicles and prevent hackers to come in, or suppliers who are providing components are going to do that. Now, there are many tier 1 suppliers who are looking at this, Lear, Aptiv, and others who are trying to figure out. It is not yet clear whether who will have the upper hand in implementing the cyber security protocol, whether it be the OEMs or the tier 1s. Maybe it's a combination, because the issue is, where will the liability lie? So the liability is the issue. The problem, well, we all know that despite all the resources we have, cybersecurity happens, it is there. So there is a high chance that people will break into vehicles, at least initially, until the protocol is defined and the systems are hardened enough. But there is a possibility that initially, at least as we go through the developing pains of cybersecurity, we may have some issues.
Anyone else want to touch on that question?
Yeah, you just have to have extra pocket money to pay the ransom to get your vehicle.
Why don't we all buy Bitcoin? Then we can pay it in Bitcoin. So.
Well, part of it too, though, I do think some of that technology already exists, and so I think that's actually, quite frankly, a risk even today, not just once electrification becomes universal.
Yeah. Okay, I think that wraps up our questions. I want to say thank you very much to our panelists for their time. It was a great presentation. I want to say thank you to our sponsors and to our participants. And with that, we will end this part of the presentation, and a reminder that the networking session will start immediately after this. Thank you again, everyone.
Thank you.
Thank you.